Hey, everybody, and welcome back to the Teaching Tax Flow podcast. Today, episode 126. We are looking at RMDs. That's right, another acronym from the Teaching Tax Flow world. But before we dive into this one, let's take a brief moment, as always, and thank our episode sponsor.
This podcast is sponsored by The Mortgage Shop. Are you looking to qualify for an investment credit loan without jumping through hoops? That's easy. They have loans with LTV up to 89.99%. Exploring their products and discovering how they can work for you is simple. Just visit mortgage.shop or call 865-325-2566 and tell them TTF sent you.
Hey, everybody, welcome back to the Teaching Tax Flow podcast. Today, as you heard in the intro, and hopefully you read in the show notes, we're looking at RMDs. So it's not EFTs, nothing with all these other acronyms that we always bring out. RMDs. So what exactly does that mean? We're going to get into it. Chris Picciurro, welcome back, sir. How are we doing today?
I'm doing great. How are you doing today?
I'm doing good, man. I feel good that we are going to decipher another acronym here for these things, because it's almost like when we get caught up with them, and I think I know all of them, it's like, oh, here comes another one. They just like fly in, out of the sky and kind of land on my shoulders. So there's a good one. So let's look at these required minimum distributions, and really, obviously, what they are, but who they apply to, and just a full-on understanding discussion around this.
Yes, our required minimum distributions are not. We think about them in general, and we're going to jump into this, is pertaining to people in their 70s. However, they could pertain to people at any age, depending on if they're a beneficiary of a retirement account or something like that. So first, we're going to talk about the history of required minimum distributions, and then we're going to look at what the current rules are for 2024, 2025, deadlines, and then John, this teaching tax flow. We're going to take a couple minutes to provide people that are tangling with RMDs with some tax planning opportunities, and then just some thoughts moving forward. But let's before we jump into RMDs, or remember, required minimum distributions. What an RMD is it's a requirement for someone that has money in a pre-tax account. So let's say an IRA, individual retirement account, that you are required to take that money out of the account at some point. Now, let's think about this. When the money was put into the IRA, 99% of the time, maybe 99.9% of the time, you get a tax deduction for it, or it goes into your account pre-tax. So like a 401k plan, you're putting that money in pre-tax. You're not paying a federal income tax on the money that you put into the retirement account. So ultimately, you either get a deduction for it, or it's going in pre-tax. So there's a big benefit on the front end of these retirement accounts. The money then grows tax deferred. There's a difference between tax deferred and tax free. But as it grows tax deferred. And then at some point, when you take the money out of the account, it's taxable at that time. So let's say you put $100 into an IRA, John. The $100 grew to be worth $400. As that growth occurs, you're not paying tax on it. You could even sell mutual funds, bonds, stocks, real estate, whatever, within that IRA and not pay any tax on it because it's in the IRA. Now, that $100 grew tax deferred to $400. You go take that $400 out, you're going to pay tax on that $400 at whatever your tax rate is the year you take it out. So the IRS, that's a huge benefit to get a tax deduction and then that tax deferred treatment. So the IRS says, remember, one of our 3 laws of teaching tax flow, your tax agencies are your involuntary business partners. So the IRS says, look, you can't just kick the can down the road your entire life here. At some point, someone's got to pay tax on all this tax deferred growth, all this money that's sitting in these retirement accounts and no one's paid tax on, and someone got a tax benefit. So that's
a great way to say it. Too, because it's almost like they're coming up saying, all right, buddy, you've reaped the benefits for so long, but time to take that cash and put it back out into the ecosphere. Like quit hoarding
have that money
at some point.
Go through our tax system again, because right now it's on the sidelines of the tax system. So the original required minimum distributions were introduced back, John, before you were even born. And I was probably in diapers. And you know what? I probably had a sweet head of hair at the time. The Revenue Act of 1978. All right. And and that was when required minimum distributions were started. We had a big tax reform act in 1986. John, you like to make jokes about my age. I was not practicing tax in 1986. I was 11 years old, and I was running a little baseball card outfit out of my basement.
A little operation, right? Were you paying tax on the income from the baseball
It
card
was a
business there,
hobby.
sir?
It
Okay,
was a
there we
hobby,
go.
okay? So in
It's a-
2019, the Secure Act raised the required minimum distribution age to 70 and a half, from 70 and a half to 72. And in 2022, Secure 2.0 Act, oh yeah, guess what? We have a lot of content on the Teaching Tax Flow um, YouTube channel about this stuff. Raised the RMD age to 73 and then eventually 75. What does that mean? It's at that age, if you own an IRA, that you have to begin taking money out of the account. And there are significant penalties if you fail to make a required minimum distribution. We're going to touch on that also because the IRS got a little friendlier, a little gentler on those penalties. But I mean, real story, John, I had someone in the Teaching Tax Flow community, a financial advisor, reach out to me and say, I've got a little situation. And we talked to a taxpayer. They are mature aged. Their spouse passed away, and they were required to make these minimum distributions, and they have not made these minimum distributions for 9 years. So that's a sticky situation.
Oh, yeah.
So yeah,
That's
so
like the IRS
ultimately,
coming in and saying, you know what, we require you to take these. If you don't, you're going to pay us some way or
right.
another by way of fines. And rightfully so, I guess, right?
So in general, anyone 73 or older are required to take distributions from their tax-deferred accounts. Tax-deferred 401ks, IRAs, 403b, etc. With the Secure 2.0 Act, we no longer have to take RMDs out of Roths. That makes sense, right? And that's why we talk about the power of tax-free income and growth, and why a Roth IRA could be extremely valuable because I can continue to grow without having to take the money out tax-free. So your RMD age ultimately is based on your year of birth. But think about once you get to your mid 70s, you're going to be required to start taking money out of those retirement accounts.
Makes sense. Makes sense. And it's good to kind of have that gauge, right? You just can't throw it in there and say, oh, well, I'll take it when I need it kind of deal. You don't exactly have the full on luxury in this case.
Right. I mean, obviously, that's a good point. You can always take out more than your required minimum distributions. You can take distributions out of your retirement accounts before you hit your 70s. It's going to be taxable. But the thing is, this is what a lot of people say, I don't necessarily need this money. I want it to continue to grow tax deferred. So I want that to grow.
And Chris, I'd be very curious too, just with, individuals, unless they're told about this, I can see this being one of those things that, people just don't know really. I mean, you would never think like, oh, they're going to make me take it out of this, because I've been, adding to it over the years. So I'm glad we're covering this too. And to be honest, I forgot at what point it was probably you that told me about this.
Mhm.
I didn't even know it was a thing. So I'm kind of speaking from the heart
Yeah,
here a
so
little bit.
what'll
That
happen?
This is good. We're covering these.
What will happen is once you start getting to that point in your life, whoever the fiduciary is typically for your IRA or your 401k or 403b is going to be reaching out and notifying you, or your financial advisor, hey, you've got a required minimum distribution to be taken. Okay, so you're going to get notified. However, what happens is there are many times where you have spouses where one kind of runs the finances, one doesn't deal with the finances, and the one that runs the finances passed away, and the other one has no idea about these RMDs. Or could be a situation where you inherited a retirement account and you didn't know that you were even the beneficiary, that you were required to make minimum distributions. So this is where you made a good point. You've got to make sure that you're surrounding yourself with your board of directors, and working with financial advisors or someone to help you navigate through this. Now, a question always comes up, well, how in the heck do we figure out what my required minimum distribution is? So there's a two-prong, I look at it as a two-prong calculation. You first look at what your account balances are on December 31st of the previous year. So we are, let's say it's spring of 2025. Our RMD for 2025 is going to be based on your account balances December 31st of 2024 in those retirement accounts. And then you look at that and you divide it by a factor in the IRS Uniform Life Expectancy tables. So ultimately, if you're 90 years old, your RMD is going to be a lot higher than if you're 76 years old with the same account balance. So that's now one thing that one practitioner tip you need to know is that, John, let's say you have 3 IRAs, right? And all of them have $100,000 in them, and your RMD is 20 grand. You only have to satisfy that RMD from any of these IRAs. You only have to take out 20 grand. You don't have to take out money out of each one, if that makes sense.
Gotcha.
Because you might
so
have
it's
different
not
IRAs.
so it's not a cumulative. It's a cumulative number, not a one out of each account to
correct
get up to that sum.
And then people say, well, how the heck's the IRS going to figure this out, right? Well, they do. And especially with AI and technology, I think enforcement's going to be higher and higher. Why? Well, the IRS has your date of birth. They also know how much money's in your retirement accounts. There's a form, I think it's a 5498, that's an annual reporting from each retirement account to the IRS saying this was the balance in the previous year. So there are ways the IRS, and I think with AI and computer learning, they're going to start enforcing this, because the next thing we're going to talk about are the penalties. So the penalty for missing your required minimum distribution, and this is just a federal penalty, right, was 50% of the RMD. So in my case, $20,000. Let's say your RMD was 20 grand, John. First of all, you have to take the 20 grand out and pay tax on it. Second of all, you have to pay 50% of the 20 grand as a penalty.
Oh, that's brutal.
Not a good look.
That's
so there.
No.
The Secure 2.0 Act, remember I said, well, the IRS got kinder and gentler. They did relax that penalty from 50% to 25%. And actually, if you correct your boo-boo quickly, there's something called a correction window. You can get that penalty down to 10%. So, and if you're listening to this and you're a little bit confused, take a deep breath. I want to tell you that, most people that listen to this podcast know I am very humbled and honored to be one of the National Association of Tax Professionals instructors for what we call tax season updates. I've had the honor of being able to teach 300 to 400 tax professionals in the fall and winter, peer to peer. Now, the secret is I will learn way more from them than they learn from me. That being said, we had a significant amount of content this year, and there's a 16-hour course that these folks take about Secure 2.0, required minimum distributions, and this penalty relief. So this is something that even tax practitioners like myself are continuously learning about. And I think the takeaway would be here, am I required to do an RMD? There are reasons, and we're going to talk about some tax planning strategies. There are reasons that you might want to start converting, and this is why we talk about Roth conversions when you're in that lower marginal tax rate year, money out of your traditional IRA into the Roth, because you already can see the RMD, your RMDs will be less. Because think about it like this. We say either you pick your tax or the IRS picks your tax. If you do your planning, you're picking the tax. But if you do no planning and you just don't do anything, and now you have these RMDs, the IRS picks your tax. And I've seen cases where these RMDs are significant amount of money. In so fact that, one, it triggers your Social Security to be taxed at 85%. Two, it could be so much that it increases your taxable income so that your Medicare premiums are higher than others. There's like a surtax on these Medicare premiums. So again, even if you're in your 40s listening to this, driving around, going for a walk, a jog, it's something to start considering of, maybe I should start putting more money in my Roths to avoid the RMD down the road.
Right. Great advice there. And it all comes down to knowledge and planning, right? If you only have one of those, it's really no good. Right.
Exactly. You've got to take an action. And that's where the, Teaching Tax Flow community and Defeating Taxes private Facebook group come into play. We field a lot of questions about this. Let's leave everyone with a couple of minutes of strategies, right? What can we do to manage these RMDs? Again, I want to make I feel like I have a broken record, John. You've been with me a lot where people come up to us, people see us in the airport. No, people don't know the heck we are in the airport. But when we're at a conference or speaking somewhere, Yes. Hey, think this, that, and other thing. I was thinking about doing this, but I don't want to pay the tax on it. It'll all go to taxes. No, your entire RMD is not going to go to taxes, right? It's whatever your marginal tax rate is. Um, However, what we're trying to do is legally and ethically reduce the tax you pay in your lifetime. So what could we do, if you are subject to either avoid RMDs, kind of drive. It's like driving through Atlanta, John. There's that bypass that you can kind of go around the city. Do you want to drive around downtown? Avoid the RMDs. Or if you don't need the money, what should you do? So one of the things, when we actually have a podcast episode on the QCDs, Qualified Charitable Distributions. So if you are in that situation where you're required to take money out of your IRAs and you really don't, quote unquote, need that money, and you donate money to a charity or a church anyway, you can take up to $100,000 of your required minimum distribution and send it directly to the charity and pay no tax on that money, and you still get to fulfill your charitable desires. That's called a qualified charitable distribution, up to $100,000 per year. It's a very powerful strategy, because what we're seeing people being forced to take, let's look at our example, that $20,000 out of their retirement account, and then we're looking at their tax return saying, you're donating $15,000 a year to your church. Have you considered just taking the 20 grand and sending it right to the church? It'd actually reduce your tax, and they'd get $5,000 more money. So that's one option. The second option might be, as I already mentioned a little bit, start looking at Roth conversions right now for the future. Even you could do a Roth conversion at any age. You could be 30 years old and do a Roth conversion. You're going to pay the tax on that conversion in the current year. You're not going to pay the 10% penalty, but then you never have an RMD. Real story, John. I'm working on a tax planning case right now in our private practice, and we're going to be working with this person. They converted $6 million worth of IRA money to a Roth. They accumulated their entire life and said, I'm going to bite the bullet. I'm going to convert all of this year, and I'm never going to pay tax again, because now their income's not going to meet the threshold over the standard deduction. Their Social Security won't be taxed for the rest of their life. Now, do I recommend someone do that? Not without the careful planning. So what we're going to do is we're going to pair that with some tax strategies to offset some of that $6 million, or find some tax credits available. So again, that's where the tax planning comes in. It's almost like, if you're going into surgery, make sure you have some anesthesia, right? We have that available now in 2025. So if you're going to make a big move like that, make sure that you're doing some tax planning and strategy to couple that with a big move. If you're still working, and you can delay your RMDs, from a 401k plan, as long as you're not a 5% owner of the company. So that's another strategy for delaying it. And then, like I said, managing your tax bracket. John, I'm gonna put you on the spot.
Oh boy, here we go.
Yes. What's the most important number when it comes to tax planning and strategy? What's the number one KPI?
The number one, we're going to say your marginal tax rate.
Nailed it. So
not your tax
marginal
bracket.
Tax rate. Pardon?
Not your tax bracket.
Correct. So manage that marginal tax rate, and if there's a year that you have a huge deduction, maybe pair that with some income. It's all about managing it, because remember, if you do nothing, you're going to be required to take these distributions out at whatever the government's tax rate is whenever you take it out, which we don't know. It'd be like, John, you go into a restaurant saying, hey, I'm going to have a meal. I'm going to walk out the door now, fat, dumb, and happy, right? And not that you're dumb or fat, but you're happy. That's just one of my dad's phrases, fat, dumb, and happy. I get up, I walk out, and the restaurant says, don't worry about paying. But in 15 years, we're going to send you a bill for whatever the value of that hamburger was. And that's what people do all the time. So it's just something to think about. So future RMDs, right? With life expectancies getting longer, do we think RMD age will increase? I think with Secure 2.0 Act, the RMD age is going to increase to 75 starting in 2023. That could change with legislation, right? We don't know what's going to happen. There are also, as we wrap this up, something to consider, and I think this might be a good podcast topic in the future. I'm talking about RMDs from the perspective of it's my IRA. If you have beneficiaries of the IRA, there are special considerations. So there are special considerations for inherited IRAs. There are something, if you're a non-spousal beneficiary versus spousal beneficiary, depending on your age, there's this concept of a designated beneficiary and a non-designated beneficiary. So the point is, if you are a beneficiary of an IRA or retirement account, you still could be subject to RMDs that are different than the 73-year-old rule. Definitely talk to us, and I think we might put something together for that as well.
Awesome. Well, it's always good when one good topic comes from another one, right? And then, so
absolutely.
Chris, too, as you alluded to this as well, too, and, we talked on it, it's all about kind of harnessing the knowledge on it, right? So anybody who's listened to this, if this is your first time listening, if this is your 125th time listening to it, doesn't matter. Check out YouTube, as Chris mentioned there too, just our channel. We have so much content on there, and it's easily digestible is the best way to put it. Short little snippets, some of it's a little longer form. You're in control of what you listen to, what you watch, and really what you learn. So it's not like you're going to have to log on and watch a 2.5 hour video and hope you can find what you're interested in. It's cataloged beautifully. So check that out. We're happy. And I say that too because Chris referred to me as being happier earlier. So here I am, doing the happy dance. We have some of the best content that we can think of and some of the best guests that we could find to talk on certain topics on our radar. So over the next couple months, we'll be releasing more and more of this stuff. As we always say, it's kind of the TTF snowball, as you will. And by the way, Chris, I feel much more comfortable saying that now, being that I'm in Michigan and the snow is melted. I can refer to snowballs as a good thing.
Melted. The other thing is, John, and just I feel like I'd be remiss if you missed your RMD. We actually have some content on that. Take a deep breath, get with a tax professional as soon as possible. Make sure you take the missed RMD as soon as possible, and then work with a tax professional to remedy it and try to find a way to not pay the 50% penalty. Maybe there's a special form called the 5329 that gets filed. But again, don't not take it. Talk to a tax professional. We get referrals all the time in the teaching tax law community from financial advisors that run across new clients that didn't know they had to take an RMD. So you're not the only one. Let's get it remedied. And again, I think that that might be a podcast topic in the future. As far as
I see it as a trend, right? So it's almost very similar to a couple episodes that we've done on IRS notices. The worst thing you can do is nothing. So don't sit around if you haven't taken that and say like, oh, I'll get to it. I already missed the deadline. All you're doing is kind of compounding the gut punch when it comes time to pay the piper, right?
Absolutely.
Awesome.
You don't want to have
awesome.
You don't want to have to be too far behind the piper.
Yep. Oh yeah. Nobody likes a piper that much. But anyways, well, we will see everybody back here again next week on the Teaching Tax Flow podcast. Same day of the week, different time, roughly, completely different topic. By the way, I love tweaking this a little bit every week. I don't even remember where it started. I don't know, came up with this little outro, whatever it is. But as the case, it always remains true. We'll see everybody back here on the podcast. Have a great week.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.